The movie version begins with private jets, founders in black turtlenecks, and billion-dollar announcements splashed across financial headlines. The real version begins at 11:43 p.m. on a rainy Tuesday inside 69 Grosvenor Street, Mayfair. The office is nearly silent except for mechanical keyboards and the low hum of Bloomberg terminals. Someone notices a decimal placed one digit too far inside a valuation sensitivity model. The mistake inflates enterprise value by $940 million. It takes 38 minutes to catch. 38 minutes is enough for the file to reach senior partners. Nobody raises their voice. The spreadsheet simply returns with tracked changes. In this business, careers rarely explode, they erode. Level 1, Investment Analyst. You are 22 years old. Your title is Investment Analyst at SoftBank Vision Fund's London investment team. Your compensation package looks enormous to everyone outside finance. $165,000 base salary and a $45,000 year-end cash bonus if the fund performs, and your reviews remain flawless. Total compensation, $210,000. There is no carried interest, no equity participation, no ownership. You are paid to reduce uncertainty for people whose signatures move billions. Your apartment sits 43 minutes away by the Jubilee line. You rarely see it awake. The alarm rings at 5:50 a.m. You leave before sunrise and return after midnight, often enough that your neighbors assume you travel for work. You do not. You simply live inside Excel. Your world revolves around one equation: weighted average cost of capital versus enterprise value divided by annual recurring revenue. WACC determines whether the required return justifies the risk. EV/ARR determines what the market is willing to believe. Between those two numbers sits every investment memo you produce. If comparable AI infrastructure companies trade at 18x ARR, while your target requires a 26x multiple to justify the proposed investment, your model must explain why. Every assumption becomes evidence. Every assumption can also become ammunition against you. At 8:17 p.m. on a Thursday, a portfolio company's finance team sends revised revenue figures. Annual recurring revenue declines by just 6.8% after correcting customer churn. The change looks insignificant until the valuation model recalculates. The justified enterprise value falls by $1.34 billion. The investment committee meeting starts at 8:30. You rebuild the model from scratch in 11 minutes. One broken formula links operating expenses to historical revenue instead of projected revenue. You catch it with 4 minutes remaining. The corrected model preserves the investment thesis, but confidence has already disappeared. The committee delays approval by 3 weeks. Lawyers, consultants, and technical advisors continue billing. The additional diligence costs $4.8 million before a single dollar is invested. Nobody blames you. Nobody congratulates you either. Losses teach faster than wins because wins disappear into quarterly reports. Losses become mandatory reading. Before you are trusted to value billion-dollar companies, you first learn that the most dangerous number in venture capital is not a bad valuation. It is a believable one, built on a spreadsheet that nobody questions. Level 2, Investment Associate. You are 27 years old. 5 years have passed since your first valuation model. You now sit on the opposite side of the conference room. Analysts build the spreadsheets. You decide which questions they forgot to ask. Your compensation climbs to $340,000 a year, $210,000 base salary, a $130,000 cash bonus, and occasional opportunities to co-invest small amounts alongside the fund. On paper, you are wealthier than you ever imagined. In reality, nearly every bonus disappears into London rent, taxes, and investments you are expected to make to prove conviction. Your performance is no longer measured by flawless models. It is measured by one brutal metric. Can today's investment secure another funding round at a minimum 1.5x valuation step-up within 18 months? That single number determines whether the Vision Fund's paper gains survive or collapse. A company valued at $8 billion today must realistically attract investors at $12 billion to $16 billion before the next financing. Anything less begins pulling down the fund's net asset value. Every investment memo becomes a forecast of future belief. At 10:02 a.m. in London, your phone vibrates. It is 2:02 a.m. in San Carlos, California. The founder of one of your largest AI portfolio companies has published a 23-post social media thread announcing confidential customer metrics while the company is preparing its S-1 registration. The posts violate SEC quiet period expectations. Within minutes, screenshots spread across financial media. The IPO is frozen. Investment bankers stop investor meetings. External counsel joins emergency calls. Public relations teams begin drafting statements before sunrise. The planned exit is worth nearly $500 million to the fund. By the end of the week, the IPO is postponed indefinitely. Additional legal work, revised filings, and delayed underwriting cost approximately $18.6 million. None of that includes the opportunity cost of a market window that may never reopen. You spend 78 consecutive hours between London and California video calls without returning home. Your girlfriend stops asking whether you'll make dinner. Your parents begin texting instead of calling because calls interrupt meetings. You discover that venture capital is not about predicting technology. It is about predicting human behavior under pressure. Models fail because people fail. Markets rarely forgive either. You leave the office at 1:18 a.m. on Saturday. The streets of Mayfair are empty. For the first time, you realize your reputation is beginning to compound faster than your salary, and both can disappear from a mistake you never personally made. Level 3, Senior Associate/Director. You are 30 years old. Your title changes to Senior Associate, then Director. The promotion feels quieter than expected. There is no celebration. Your access badge changes overnight, and your calendar fills with investment committee sessions instead of modeling reviews. Your compensation reaches approximately $780,000 a year, $360,000 base salary, a $270,000 cash bonus, and roughly $150,000 in shadow carry. The carry is only a promise. It cannot pay your mortgage, and it disappears if portfolio performance deteriorates before vesting. Your primary metric remains unchanged, but the consequences become larger. Every recommendation must produce a valuation step-up that comfortably exceeds the fund's effective cost of capital. A company that cannot justify a future multiple expansion is no longer simply a disappointing investment. It becomes a drag on the Vision Fund's reported net asset value, affecting fundraising conversations thousands of miles away. Your work stretches across London, Tokyo, and Silicon Valley. Time zones replace weekends. At 6:01 p.m. in San Carlos, your phone rings. It is 2:01 a.m. in Tokyo. One of the fund's largest APAC mobility investments is facing an unexpected regulatory suspension. New licensing restrictions halt operations across multiple cities. Cash reserves will last less than 48 hours. Payroll alone exceeds $62 million every month. If the company files for bankruptcy protection, billions in existing equity could be marked down immediately. The investment committee cannot assemble quickly enough. You spend the next 14 hours coordinating lawyers, restructuring specialists, and regional partners across 3 continents. By sunrise in London, the team structures a $900 million emergency bridge loan using highly dilutive preferred securities with liquidation preferences designed to keep the company alive. Existing shareholders absorb immediate paper losses exceeding $2.4 billion. The alternative is total collapse. The company survives. No headline describes the financing as a victory. Analysts call it expensive damage control. They are correct. You return home at 11:46 p.m. on Friday. Your apartment refrigerator contains expired milk and unopened groceries purchased 6 days earlier. You throw everything away before going to sleep. You begin noticing something unsettling. The higher your title climbs, the less time you spend finding great companies, and the more time you spend preventing existing ones from failing. Success becomes invisible maintenance. Losses still teach faster than wins. The difference now is that every lesson carries 9 or 10 zeros, and every decision becomes part of a reputation that follows you into every investment committee long after the crisis has passed. Level 4. Partner/Vice President. You are 34 years old. The business card now says partner. In some offices it says vice president. The title matters less than the authority behind it. For the first time, your signature can commit hundreds of millions of dollars before the full partnership votes. Your annual compensation ranges between $1.8 million and $2.2 million. Around $500,000 is base salary. Roughly $700,000 arrives as a performance bonus. The remaining value comes from carried interest that vests over several years. On paper, your net worth accelerates. In cash, much of it remains locked behind portfolio exits that may never happen. Your primary metric evolves beyond individual companies. The question is no longer whether one investment deserves a premium valuation. It is whether the entire portfolio can continue producing enough successful valuation step-ups to protect the Vision Fund's overall net asset value while exceeding its weighted average cost of capital. At 10:58 p.m. in London, an encrypted message arrives from Riyadh. It is 12:58 a.m. inside the King Abdullah Financial District. A violent macroeconomic shock has triggered a sovereign financing squeeze. The debt facilities supporting portions of the fund's leveraged investment structure are approaching collateral limits. If additional liquidity is not raised before European markets open, lenders may force asset sales under their own terms. You have less than 7 hours. The solution is painful. Working with trading desks and legal advisors, you quietly arrange secondary sales of several highly sought-after pre-IPO holdings. Every buyer signs strict confidentiality agreements. Every transaction must remain invisible long enough to avoid signaling distress to the broader market. By 5:41 a.m., approximately $3.6 billion of secondary positions have been sold at an average discount of 14.2%. The emergency stabilizes the financing structure. The discount permanently destroys more than $510 million of potential value. No press release mentions the night. The market simply opens as if nothing happened. You leave the office after sunrise carrying the same laptop that once held simple valuation models. Now it contains confidential negotiations, capable of moving global headlines if leaked. Your wife has stopped asking when you'll be home. She plans family events without checking your calendar, because experience has taught her the answer. You finally understand the illusion of control. The more authority you gain, the fewer outcomes you directly control. Founders control execution, regulators control timing, markets control pricing. Your responsibility is to absorb every consequence anyway. That is the real promotion. Not more power, more accountability for forces that never ask for your permission. Level 5. Managing Partner/Managing Director. You are 40 years old. The spreadsheets still exist, but they rarely belong to you anymore. Entire teams prepare the numbers before they reach your desk. Your job is no longer to calculate risk. Your job is to decide which risks deserve billions of dollars. Your annual compensation fluctuates between $4.8 million and $6.9 million. The base salary is approximately $850,000. Annual bonuses exceed $2 million in strong years. The rest comes from carried interest distributions, tied to realized exits, rather than paper gains. Some years, your income doubles. Other years it contracts, despite working the same hours. Your operating metric expands beyond valuation multiples. Every capital allocation decision must improve the fund's internal rate of return while preserving net asset value and maintaining enough liquidity to support existing portfolio companies through unexpected downturns. A great investment made at the wrong time can damage an entire fund. At 11:07 p.m. in London, an emergency briefing begins. Markets across Asia are already open. 3 of the fund's largest late-stage AI investments simultaneously miss their projected revenue targets. Public market technology multiples compress by nearly 28% over 6 weeks. Investment banks withdraw financing for several planned IPOs. Nothing inside the companies has fundamentally changed. The market's willingness to pay has. Your team spends the next 72 hours reviewing every material holding above $1 billion. Valuation committees challenge assumptions that looked conservative only a month earlier. Discount rates increase. Comparable multiples contract. Forecasts are rewritten. By the end of the review, approximately $11.4 billion has been removed from the portfolio's reported paper value. No cash leaves the bank. No factories close. No engineers stop writing code. Yet billions disappear because confidence is no longer priced the same way. Investors call asking whether the markdown represents the beginning or the bottom. You cannot answer honestly because nobody knows. You answer carefully instead. The hardest lesson arrives quietly. You once believed venture capital rewarded finding extraordinary founders. Now you understand it rewards surviving extraordinary cycles. Most careers are not destroyed by one catastrophic investment. They are destroyed by refusing to recognize that yesterday's valuation no longer exists. You return to Mayfair before sunrise. The office cleaners are just arriving. For the first time in nearly 2 decades, you realize your greatest asset is no longer your judgment. It is the trust that limited partners, founders, and colleagues continue placing in that judgment, after watching billions of dollars disappear on paper without losing confidence in the person making the decisions. Level 6. Managing Partner/Executive Committee. You are 44 years old. There are no larger titles left to chase. Your compensation ranges between $9 million and $14 million in a strong realization year. Roughly $1.2 million is fixed salary. Everything else depends on carried interest, GP catch-up distributions, and direct co-investments exiting at prices the market is willing to accept. Your reported net worth exceeds $180 million. Most of it exists on paper. Your primary metric is no longer a company. It is capital allocation across an ecosystem worth tens of billions of dollars. Every decision must protect the relationship between the fund's cost of capital, portfolio net asset value, liquidity reserves, and the confidence of sovereign investors whose commitments span decades rather than quarters. Your calendar revolves around 4 cities: London for investment committees, San Carlos for founder negotiations, Tokyo for executive strategy, Riyadh for conversations that determine whether the next fund exists. At 11:02 p.m. in London, your phone vibrates. It is 2:02 a.m. in Riyadh. Global credit markets have tightened after another macroeconomic shock. Questions begin circulating about leverage inside several technology investment vehicles. Limited partners are not panicking. They are becoming cautious. The distinction matters. Over the next 48 hours, you meet sovereign representatives, lenders, auditors, and portfolio CEOs. Nobody asks for guarantees. They ask whether you still believe your own valuations. You answer with data instead of optimism. Some companies deserve additional capital. Others receive nothing. One portfolio business employing more than 9,000 people requests a $700 million follow-on investment. 6 years earlier, you would have approved it to defend the existing position. Today, you decline. The decision immediately writes down another $2.1 billion in paper value. Keeping the company alive would likely consume billions more with no credible path to a valuation step-up. The loss becomes permanent. So does the lesson. For 22 years, every promotion promised more control. Instead, every promotion transferred control somewhere else. Analysts controlled models. Founders controlled execution. Governments controlled regulation. Public markets controlled pricing. Limited partners controlled future capital. Your responsibility expanded while your authority quietly narrowed. You finally understand why the most experienced investors speak less than everyone else in the room. They have learned that certainty is usually expensive. Humility is cheaper. When you leave the Mayfair office after another 16-hour day, there are no photographers waiting outside, no television crews, only a taxi driver checking the address before pulling into traffic. The numbers attached to your name are extraordinary. The operations sustaining them are fragile. Paper wealth can disappear between quarterly valuation meetings. Trusted partnerships built over decades usually survive. Those partnerships become the only asset that consistently compounds. On another Monday morning, 5 floors below the executive conference room, a new analyst opens a valuation model for the first time. The spreadsheet looks impossibly complicated. Your name appears in the approval history beside investment decisions worth billions of dollars. The analyst studies the track record and imagines confidence, certainty, and effortless success. They cannot see the delayed IPOs, the emergency bridge loans, the sovereign financing calls after midnight, the billions erased by changing market multiples. They only see the survivors. In a few minutes, they will begin editing cells that seem too small to matter. Years from now, they will discover that careers in growth equity are rarely defined by the investments that work. They are defined by the losses that teach, the discipline to accept them, and the judgment to keep allocating capital anyway. The market never remembers your intentions. It only prices your results.